Welcome to The Explainer. Personal finance can feel overwhelmingly complex. So today, we're going to reframe it. We're turning it into a game that you can actually win, one level at a time. We're going to walk you through the path to financial mastery with a really clear step-by-step guide.
All right, so here's our quest map for today. Think of it as our game plan. We're going to start with the mind game, then build a rock-solid foundation. From there, we'll look at an early exit strategy, learn how to invest with a safety net, and finally, get you ready to take on the final boss of financial independence.
Okay, level 1. Before we even touch a single dollar, we've got to master the game that's happening right between our ears. This is all about your investor psychology.
So, let me ask you this. Are you a truly rational investor? The old school financial theories all assume we are. They paint this picture of us as these perfect, logical robots who always make the best financial choice. But let's be real for a second. Are our decisions about money always perfectly logical? I didn't think so.
And that's exactly where this idea of behavioral finance comes in. It basically throws that old, perfect rationality idea out the window. It's the science of why we do the things we actually do with our money, not just what some textbook says we should be doing.
So what's really fascinating here are these common glitches in our thinking. Overconfidence is that little voice that says, oh yeah, I can totally time the market. Loss aversion? That's the reason a $1,000 loss stings way more than a $1,000 win feels good. And herd behavior? Well, that's just following the crowd, usually right off a cliff. Just knowing these exist is the first step to leveling up.
Okay, mind game conquered. It's time for level 2, building your financial foundation. This isn't the flashy stuff, okay? This is about building a financial fortress, a blueprint for wealth that's built to last.
Now, the secret sauce here is the order. You have to do these steps in order. Don't even think about jumping to step 6 before you've done 1 through 5. First, build a small emergency fund. Then, and this is a big one, grab your full employer match. That's free money, people! After that, you declare war on any high-interest debt. Then, you fully build out your emergency fund. And only then, once you're on solid ground, do you crank up your retirement savings.
All right, with that strong foundation in place, now we can get to the really exciting stuff. Level 3 is all about a powerful strategy to speed run your way to financial freedom. We're talking about the FIRE movement. So, FIRE stands for Financial Independence, Retire Early. But, retire early doesn't necessarily mean you stop doing everything. It's about getting to the point where work becomes a choice, not a requirement, because your investments are paying your bills. It's about designing a life based on freedom. And this right here, this is the engine of the whole FIRE movement. Just look at the math. If you save 10% of your income, it takes you 9 years of work to save up for just 1 year of living expenses. But jack that up to a 50% savings rate, now you're saving for a full year of freedom for every single year you work. It's a game changer.
But, FIRE isn't a one-size-fits-all kind of deal. There are different flavors. Lean FIRE is for the minimalists who want to get there as fast as possible on a tight budget. Standard FIRE is more of a comfortable middle-class retirement. And then you have Fat FIRE. That's for people who want to keep up a pretty luxurious lifestyle. And that, of course, takes a much bigger pile of cash.
Okay, so you have a goal, you have a timeline, now you need a smart way to invest to get there safely. Let's level up our investing game by talking about a super important concept. The legendary investor Benjamin Graham, you might know him as Warren Buffett's mentor, he basically gave us the ultimate cheat code for investing. He boiled it all down to 3 simple words: margin of safety. It's the absolute core of value investing.
Now, a lot of people hear margin of safety and just think, oh, buy a stock for less than it's worth. But it's so much deeper than that. You got to think of it in 3D. Yeah, price matters, but so does the company's balance sheet. Can it survive a recession? Is it actually growing? And maybe most important, does it have a competitive moat, some kind of durable advantage like a killer brand that keeps competitors away? A true margin of safety covers all of that.
All right, you've made it. This is the final level. You've built your nest egg, you're getting close to your goal, but there's one last challenge. A final boss you have to defeat. Sequence of returns risk.
So what is this risk? It's all about terrible timing. It's the nightmare scenario of a huge market crash happening right when you start pulling money out to live on. See, when you're young, a market crash is great. It's a sale. But when you're retired and selling assets to pay your bills, selling into a crash can absolutely destroy your long-term plan.
So let's look at this study from JP Morgan. It's a tale of 3 retirees, and it illustrates this perfectly.
Each starts with $1 million. Retiree A here lives in a fantasy land where they get a smooth, steady 5% return every year. It's a nice, predictable decline, and they've got plenty of money left. But we all know the market is never, ever this smooth.
Now check out retiree B. This person gets super lucky. They retire right at the beginning of a huge bull market. Those amazing early returns just supercharge their portfolio. Even with withdrawals, their nest egg grows so much that they end up with more money than they started with. That's the power of a good sequence of returns.
But then there's retiree C. And this is the danger. They retire and bam, the market tanks. They're forced to sell their investments at rock-bottom prices just to live. Those early losses combined with withdrawals create a death spiral for the portfolio, and it just never recovers. Look at that. They run out of money completely. This is the final boss we have to defeat.
So how do you beat this boss? Well, one of the best strategies is something called the bucket strategy. It's brilliant. You divide your money into different buckets based on when you'll need it. Bucket 1 is just cash for the next year or two. If the market crashes, you live off this and don't touch your investments. Bucket 2 has a few more years' worth of expenses and stable things like bonds. This all protects Bucket 3, your stocks, and gives them all the time they need to recover from a downturn without you ever having to sell them when they're down.
So we've gone through all 5 levels. We've mastered our own psychology, built a strong foundation, learned how to speed things up, how to invest with a safety net, and finally, how to defeat that final retirement boss. You've officially leveled up. The only question left is, are you ready to get in the game?